Welcome to the Depth Dive. Today we are jumping into a really interesting one, Reddit, Inc., ticker RDDT. We're looking at everything available up to October 31st, 2025.
That's right. And our reference share price for this is $194.42.
So the core mission today.
Well, it's really digging into this question. Can Reddit, with all its chaotic, authentic communities, actually become this super durable, profitable business over the next decade?
Or is that $194 price tag just way too high, regardless of how good the business might be underneath?
Exactly. That's the tension.
And look, we're not going to bury the lead here. The analysis shows, well, frankly, incredible financial success. We're talking software-like gross margins, explosive cash flow. It's impressive.
And it's a big but.
Yeah, there's this huge contradiction. You've got that success on one side and then massive systematic insider selling on the other.
Plus a valuation multiple that's, 6 times its profitable peers?
It's wild. We'll get to our estimated intrinsic value range right at the end of this deep dive.
That clash, great business, maybe not so great price. That's what we're exploring.
Okay, before we dive into Chapter 1, just a quick reminder for everyone listening, like and subscribe to Stock Analytic AI.
Yep, and for members, remember, $4.99 a month gets you that huge playlist, 500 deep dives on the S&P 500.
And we're adding the NASDAQ 100 next, exclusively for members. Plus, you can request stock deep dives. Just drop the ticker in the comments.
We'll get right on it for you.
All right, let's kick things off. Chapter 1, Business Understanding.
Okay, Reddit. It's unique. Think of it like a giant digital public square.
Made up of over 100,000 active subreddits, right? All moderated by users themselves.
Exactly, and that's key. The core product isn't something Reddit makes in-house. It is the user-generated content, the chaos, the niche discussions, all of it.
And how do they make money from that chaos?
Primarily advertising. That's the engine. And It just surged. Q3 2025 ad revenue was up, wait for it, 74% year over year.
Wow, 74%. How much is that in dollars?
$549 million for the quarter. That makes up about 94% of their total revenue.
So heavily reliant on ads. What about other revenue streams?
They're small but worth noting. Things like Reddit premium subscriptions and, looking forward, potentially licensing data for training AI models. That could be big down the line. But right now, it's ads.
And the scale here is just immense. We're talking 116 million daily active uniques, DAUq they call it.
Up 19% year over year. And 444 million weekly visitors.
It's definitely a top-tier internet property.
No question. But scale is one thing. The real strength, the moat, comes from two things. First, that powerful network effect.
Right, the classic flywheel. More users mean more content, which attracts even more users.
Exactly, and it makes it incredibly sticky. Try replicating that. You face this massive chicken and egg problem. How do you bootstrap thousands of active communities all at once?
Almost impossible. And the second part of the moat?
The cost advantage. This links back to that user-generated content model.
Because the users create the content.
And moderate it, mostly for free, by volunteers. Think about the cost savings compared to traditional media or even other social platforms that rely more on professional creators or heavy internal moderation.
That directly translates to higher margins, which we'll get to.
Precisely. But the big story right now, in late 2025, isn't just the 19% user growth, which is solid. It's the explosion in monetization. Total revenue grew 68%.
Okay, so users up 19%, revenue up 68%. That's a huge difference.
That's the key takeaway. It suggests they finally really cracked the code on monetization.
How? What changed?
Average revenue per user, ARPU. Globally, it jumped 41%.
41%.
And even better in the US, 54% growth in ARPU. That shows they're getting much, much better at selling ads, targeting them effectively, and charging more.
Is there anything specific driving that? New tools?
Yeah, they launched a new B2B product called Reddit Pro. They partnered with G2, the software review site, to specifically target those high-value software marketers.
So moving beyond just general brand awareness ads, getting more sophisticated?
Exactly. It shows a maturation of their ad tech.
But if the model's so good with these network effects and cost advantages, why did it take so long? Why are they only hitting this monetization stride now, years after, say, Meta?
That's a really fair question. The sources suggest that the very thing that makes Reddit strong, its chaotic, user-driven, sometimes edgy nature, also made big advertisers nervous for a long time.
Right, brand safety concerns.
Exactly. Which leads us into management. CEO Steve Huffman's return in 2015 was critical. He had to make some tough calls, overhaul content policies, clean things up.
Even if it meant upsetting some core users in the short term.
Right, prioritizing the long-term health and advertiser friendliness of the business.
Okay, let's transition then. Chapter 2, management evaluation.
So Huffman, his history, leaving and then coming back, shows a willingness to tackle those hard problems, like banning some really toxic subreddits, even knowing the backlash.
Which arguably paved the way for this current monetization success.
You could definitely make that case. Another interesting thing about management is their transparency. It's pretty unique.
What'd I do?
After earnings calls, the investor relations team actually goes onto the RDDT subreddit, their own stock discussion forum, and takes questions directly from the public.
Really? Wow, that's bold.
It is. It builds a certain kind of trust, though. Very open.
Okay. What about the financials under their stewardship? Capital position.
What you'd call a fortress balance sheet. They're sitting on $2.226 billion in cash and marketable securities.
$2.2 billion. And debt.
Virtually no long-term debt. Very clean.
And what are they doing with all that cash? Dividends? Buybacks?
Nope. The expectation is they'll keep retaining all free cash flow for reinvestment in the business. No payouts planned.
So the big question then is, how well are they reinvesting it? What's the management report card look like?
That's where return on invested capital, ROIC, comes in. And Reddit's normalized ROIC is seriously impressive, 22.37%.
22%? How good is that, for context?
Anything consistently above, say, 15–20% suggests management is exceptionally skilled at generating profits from the capital they deploy. 22.37% is top tier.
So that number, plus the huge cash pile, suggests they really are executing effectively.
It's strong evidence, yes.
All right, let's get into the numbers themselves. Chapter 3, financial analysis.
This is where you really see the transformation. Reddit is now undeniably a highly profitable cash-generating machine.
Let's hit those Q3 2025 highlights again.
Okay, revenue up 68% year-over-year, net income up a staggering 444% year-over-year.
444%.
But again, the margins are the story behind the story. That gross margin, thanks to the user gen model, hit 91.0%.
91%. That's
Yeah.
like a pure software company margin.
Exactly. Almost unheard of for a platform so reliant on, well, messy human content.
And net profit margin for the quarter.
A very healthy 27.8%. But for me, the real star is free cash flow, FCF.
Why FCF specifically?
Because it's the actual cash the business generates after all expenses and investments. It's harder to manipulate the net income. And the turnaround here is stark.
They were burning cash before, right?
Yeah, negative FCF from 2021 through 2023. Then boom, in Q3 2025 alone, they generated $183.1 million in positive free cash flow.
Just in one quarter. That's a massive swing.
It's undeniable operational success. No question about the business quality at this point.
Okay, but here comes the tension again.
Here it comes. The valuation. The business is great, the cash flow is pouring in, but the stock price, that's where it gets complicated.
What's the number? The PE ratio.
Reddit's trailing 12 months price to earnings ratio is, well, it's sky high. 177 times earnings.
Wow. Put that in context for us against peers.
Okay, so Meta Platforms, the big dog, trades around 27.2 times earnings. Pinterest, maybe a closer comp in some ways, trades around 11.5 times.
So Reddit is trading at more than 6 times Meta's multiple and vastly higher than Pinterest's.
Right. It implies the market isn't just expecting growth, it's expecting sustained hypergrowth for a very, very long time. Near perfection is baked in.
That feels like a huge bet the market is making.
It's a gargantuan bet.
Okay, given that valuation, it's probably no shock that this is a controversial stock. Let's move to Chapter 4. Market sentiment.
Yeah, the sources describe it perfectly. Deeply polarized. It's a classic battleground stock.
You've got the bulls and the bears lining up. What's the bull case argument from analysts?
Wall Street consensus is actually a moderate buy. The analysts focus on that ARPU explosion, the ROIC, the FCF generation. Their average 12-month price targets are somewhere between $213 and maybe $229.
So analysts see more upside, even from $194.
They do, but then you have the bears. And they aren't just talking, they're putting serious money behind their view.
How so?
The short interest, it's exceptionally high. 15.3% of the free float is sold short.
15%. That's huge.
Yeah.
That represents a very large, very sophisticated bet that the stock price is going down.
Absolutely. These aren't casual investors. These are often hedge funds and professionals making a calculated negative bet.
Did we see this tension play out recently, like after the last earnings report?
We did, actually. Q3 earnings were by all accounts, phenomenal. They beat expectations across the board, a real blowout quarter.
So the stock must have soared.
You'd think so, right? But it didn't. It actually traded below its 50-day moving average, which was around $224.60 at the time.
So they deliver an amazing quarter, and the stock shrugs, or even dips.
Pretty much. It reinforces that idea. Near perfection was already priced in. The market met incredible results with, frankly, indifference.
That's a powerful signal about expectations. Okay, let's look inside the company. Chapter 5. Ownership structure.
We know institutions own a lot, about 88.2%. That can contribute to volatility sometimes.
But you mentioned something earlier about the insiders.
Yes, and this, for me, is maybe the most compelling piece of the bear case. It's not about market sentiment. It's about the actions of the people who know the company best.
The executives themselves, what are they doing?
They are selling. Consistently. Significantly. We're seeing a clear pattern of insider selling.
How much selling are we talking about?
Over the last 3 months covered by the data, insiders had a net selling of over 454,000 shares.
Net selling, so selling more than they're buying or holding.
Much more. And these aren't small, insignificant sales for diversification. The COO, Jennifer Wong, sold over $9.8 million worth.
Nearly $10 million.
And the CEO, Steve Huffman, the guy who turned it around, he sold $4.1 million worth.
Okay, that definitely raises a flag. This is the core contradiction you mentioned at the start.
It absolutely is. If the business is generating 22% ROIC, churning out $183 million in SCF per quarter, and if management truly believes the intrinsic value is far higher than $194.
Then why are they systematically cashing out significant portions of their personal stakes at these prices?
Exactly. It forces you, as an investor, to ask some hard questions about their confidence in the stock's future trajectory, even if the business is performing well right now.
A very important point. All right, let's consider external threats. Chapter 6. Risk assessment.
The most obvious one, given the 94% reliance on ads, is the overall economy. Advertising is cyclical. If there's a macroeconomic slowdown...
Ad budgets get cut, and Reddit feels it. Standard risk for ad-based businesses.
Right. But the sources highlight a much more specific, almost mechanistic threat that's happening now. It's the U.S.-imposed tariffs of 2025.
Tariffs. How do trade tariffs hit a social media company like Reddit? That seems indirect.
It connects directly to their key advertisers. Remember that explosive ARPU growth? A lot of that is driven by e-commerce sellers, small and medium businesses using Reddit to reach customers.
Okay.
Well, these new tariffs eliminated something called the $800 de minimis exemption.
What did that exemption do?
It basically allowed businesses, especially smaller ones, to ship goods valued under $800 into the U.S. without paying import duties. It was a big cost saver for them.
So taking that away directly increases costs for those exact SMB and e-commerce advertisers who are fueling Reddit's growth.
Precisely. Their cost of goods sold goes up. That squeezes their profit margins.
And when margins get squeezed?
Discretionary spending, like advertising on platforms like Reddit, is often one of the first things to get cut back.
So the tariffs create a direct headwind against that critical ARPU growth engine.
Exactly. It's not just a vague macro risk, it's a specific policy change impacting the economics of their core customer base right now, a tangible threat to the monetization story.
Okay, that's a crucial risk factor. Let's pull it all together. Chapter 7, conclusion.
All right, summing up. The bull case is strong based on fundamentals. You've got the deep competitive moat from network effects and user-gen content.
A massive, engaged user base.
Explosive free cash flow growth, remember $183 million in Q3 alone?
And that fortress balance sheet with high ROIC showing management knows how to use capital effectively. It's a quality business.
Undeniably. But then, the bear case, which is almost entirely about the price and the risks embedded in that price.
Starts with that stratospheric valuation, 177 times trailing earnings.
Then the flashing warning light of aggressive, consistent insider selling by top executives.
And finally, that specific direct economic threat from the 2025 tariffs hitting their key advertisers and potentially dampening that crucial ARPU growth.
So where does that leave us on valuation? We mentioned a discounted cash flow model.
Right. Based on a conservative DCF analysis, which still assumes pretty high growth continues for a while, the estimated intrinsic value range comes out somewhere between $150 and $180 per share.
And the market price we started with?
$194.42.
So even with optimistic assumptions built into the DCF, the current price appears to be above the upper end of that estimated fair value range.
meaning there's little to no margin of safety at $194.
That's the conclusion from the analysis. While the underlying business quality is clearly very high, the valuation risk, combined with the insider selling and tariff headwinds, looks extremely high right now for a value-conscious investor.
So the final thought here really revolves around that tension. You have this amazing business execution on one side, but insiders heading for the exits on the other. It's profound.
It makes you wonder, what would need to change? Maybe a significant slowdown in that insider selling, showing renewed conviction from management.
Or perhaps clear evidence that the tariff impact is less severe than feared, or that advertisers are adapting without cutting ad spend drastically.
Those might be catalysts that could make the stock look more compelling from a value perspective, bridging the gap between the great business and the current high price. That's something for you, the listener, to really chew on.
Always remember that critical distinction. A wonderful business isn't always a wonderful investment.
Exactly. The sources really hammer this home. The price you pay ultimately determines your return.
Well, that wraps up our deep dive into Reddit. If you found these insights valuable, please do remember to like and subscribe to Stock Analytics AI.
And members, don't forget to drop a ticker in the comments if there's a stock you want us to tackle next.
We'll see you on the next one.
Just a required note before we sign off. This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.